So the question today is really, please clarify position sizing for equities, stocks versus ETFs. That's obviously specific to the equities here, but I'm really going to take the time to review all aspects of position sizing. So, Generon, if you pull up slide 7, it's basically just a cleaner version of that first slide, but I wanted to review this with everybody. So again, currencies, max position size of 12%, fixed income 10%, equities. So I'm sorry if that's confusing or if that's been confusing. There's two forms of equities. So generally, so again, when in terms of max sizing was 6% with equities, generally that would be referring to ETFs. Now, again, this is where your own kind of decision making inside of the process and how things get applied from a risk tolerance standpoint and a risk management standpoint does come into a factor. But ETFs would be typically a max 6%, and individual securities and equities would be a max 3%. But again, it does vary, as I've talked about on different shows, in terms of which quad environment you're in, and as well as the underlying volatility of that asset. So I'm going to get into volatility adjusting things and give some examples as well. Commodities max would be 4%, and options again kind of 1 to 2. But this is frameworks. This is frameworks that Keith has put into place, that he has spent the time to review, and this is his framework. Now, this absolutely can work for you. But if you have a higher risk tolerance, maybe you expand some of these. If you have not as bit much of a risk tolerance, or perhaps you're a little bit greener in terms of deploying or investing and that kind of stuff, perhaps you bring those down a little bit just to minimize your risk, right? Minimize your potential of making a mistake and that kind of thing. So again, just wanting to kind of reiterate that these are kind of the position sizing that Keith has built over time, but he's also a seasoned vet of 25 years. From a long short standpoint, again, the little chart there on the right is for ETFs. So this would be equity ETFs, a max of 6%, short 3. Again, it's like 50% in terms of, so if your max is 6 on the long side, it'd be 3 on the short side. If your min is 2, your min on the short side is 1. But again, if you got to adjust those for whatever your risk tolerance is and whatever your risk management component looks like. So if your max is 4% on an ETF, then your max short would be 2, right? And again, if you're kind of new to this game, going short something isn't a necessity. Like, a cash is a position, and cash is a place to potentially to park capital, right? And in the quad 4 environment, you leveraging or using all of your cash, like many of you, some are advisors, but many are just handling it on your own accounts, right? So if you don't have restrictions or compliance needs in terms of deploying all but 2% of a cash position. Now, if you do need to do that, then that goes in, or that factors into your process and your portfolio construction and what you need to do. My good friend Joe Taylor, Wealth Elf on Twitter, he actually kind of sent me a slide this morning, and I'm going to kind of I wanted to share it because I think it's a really good assessment here across the board from a power user who's leveraged Hedgeye for, I believe, 5 or 6 years now. So that'd be slide 8, Genron, and position sizing, right? So if you don't mind blowing that up, actually, that'd be really wonderful. He goes about it, or kind of shows it in terms of, I really like how he kind of visualizes the volatility there in that kind of middle left column. So again, crypto is one of the most highest volatile assets. Same with commodities. Then it goes individual stocks, basket of stocks, aka ETFs, bonds, and currency. Now, he lays out, again, this is what, this is Joe's sort of min max's sizing. But I do, does, he pulled it from, the Hedgeye and from the position sizing that Keith has relayed. So, hence where there's a decent amount of correlation here. For Joe, his individual stock, max size is 4%. But I know that he's volatility adjusting that position size. So for a stock that has higher volatility, and I'll give an example later, that max size wouldn't be 4%. It might be 2%. It could also be like 1%. And then your minimum size like moves all the way down to 25 basis points. So again, you just gotta kind of look at those individual components inside of one, what makes up your portfolio construction. And then two, not every individual stock is created equal. Some have more volatile components than others, and depending on the time frame, circumstance, or the price movement, that volatility, even if historically, it's consumer staples, and historically it has a lower beta and a lower volatility component. In any given 30-day window of time, that volatility, that underlying volatility inside of that asset might increase, and therefore that's going to impact your max size inside of that security or piece of inventory. So hopefully that's helpful. I also like the fact that he included the Alps and the Yelps, right? If you don't get your sizing right, it can really turn into the Yelps. And so it's all about risk management, risk tolerance, and going through what that looks like for you as a person. The next up, I'm going to get into a couple different examples. So let's use a long, right? So we'll use gold, which is Barrick Gold, which is an individual stock, right? So we've been GDX in particular as an ETF, and has been along for us since about November, and where again this was very coincidental because Keith referenced and gave out, listed a number of gold or just miners in general, precious metal miners that he was long this morning on TMS. So again, I guess kudos to me for being on Coach's page. But the real thing here that I wanted to show is that the difference between an individual security or potential and an ETF that's associated with it. So Barrick Gold has a realized volatility of 41.5 on a 30-day look back window. So that would be that green line there on the bottom. So just to give you an idea of what's on this chart. So this is just from TradingView. This green line is a indicator. I just typed in, you just type in realized volatility, and you'll get a couple different indicators that you can put on. I'm a fan of TradingView. It's kind of where I do most of my work, most of my like charting and stuff like that. Doesn't mean that you have to realize volatility or really any, the point here is to use some form of volatility, whether it's historical, realized, implied, whatever it might be, just have that up on your, whatever platform that you're using in your brokerage account, blah, blah, to help you assess kind of the volatility inside of that piece of inventory that you're contemplating putting into your portfolio. So on the chart there, you can see just like the price action, and then the red and blue bars are the average volume at time. So that's just kind of how I track volume throughout the day. And then the green one is the RV, so the realized volatility. So gold has a realized volatility of 41.5, whereas GDX has a realized volatility of 39. So if you go to the next slide there, Ron, again, this is using a 30-day look back. That means that like GDX and gold have a relatively similar, realized volatility component. And that does make sense because GDX is made up of a lot of other miners that might have a higher volatility component. But really what that also means is that, GDX has at 39 has a pretty significantly higher volatility component than even the VIX, which is trading around, call it 18 to 19 at the current moment in time. So GDX is, looks different than say the, vol RV on something like an XLP, right? Or even an SPLV, right? Those are two that we've had as piece of inventory recently in our portfolios. But so yes, just wanted to highlight that, right? So like GDX, even though the max in general is 6 in a quad 4 environment where volatility and can really move quickly in any given day, what I've recommended in prior shows is kind of like a max of 4.5% position with an ETF like GDX on a vol of 39. That might be 60% of that, right? Or maybe even 50%. So if it's 4.5%, maybe you're taking it to a max of 3. three and a quarter, maybe three and a half, something like that. So for me, GDX at max would be about 3%. But again, that just really depends on who you are from a risk management and risk tolerance perspective. So again, this is where you adjust those minimum sizing, you adjust your maximum sizing, and you adjust the incremental adds that you would have inside of the portfolio. Conversely, on a GLD, the next slide there, Genron, that RV is at 18. So that's basically half the amount of RV that GDX has, which means it can be double the sizing, right? And realistically, we consider GLD similar to a currency. So it's a max of 12%. Now again, with maybe for you, it's an 8 to 10% position, right? So again, just kind of like you have to kind of adjust it. But I'm really just trying to showcase the differences here and the reasons why we have different general position sizing in terms of max sizing across different parameters, even though GLD, again, is technically an ETF, but it is a reflection more on gold and gold price. So there you go. You've got, gold and individual stock, GDX and ETF, and then GLD as three different types of longs that you might have in the portfolio and how you might want to size them. Now, the next ones I have are kind of on the short side. So so I'm going to show you XLY and Tesla. So XLY has got a RV of call it around 32. 31.75 to be specific. So again, that's just one of these things where, if you're kind of going through and you're looking at the RV for XLY, XRT, QQQs, FXE, whatever it might be that we're looking at, HYG, JNK, right? So any of those components, you can compare as to like why if when Keith has provided, say, his some of his top shorts on the macro show or anywhere really, the reason why a lot of those components like junk or HYG are always at the top is because they have lower volatility components, and therefore you can naturally, or he has found that he can naturally kind of make those bigger positions overall inside of the portfolio because they don't have as much vol. And so again, this is where XLY is a 31.75 RV, but then if you pull up Tesla, the next slide, Genron, it's a 112. So that's like 3x the amount of volatility inside of one stock versus, if you're short XLY versus short Tesla. So again, I'm bringing this up because there's differences here in terms of, from a portfolio construction and a portfolio management standpoint, from a risk management standpoint, you need to be aware of like the volatility of the piece of inventory that's going into your portfolio. We've been short Tesla. XLY has been a core short of ours since February of last year. Same with XLK and QQQ. But that's where, again, regardless of when you made, if you made incremental, I'm not even going to get into kind of like when you might have wanted to cover, or when we covered in an RTA and all that kind of stuff. I'm just really trying to focus on the position sizing, the fact that a Tesla position size with a volatility component of 112. And if you look down there in the green line, it's been rising. That volatility component, can you blow that up by any chance, Genron? That volatility component has been rising since late December. It's gone from, call it in kind of around 80 to north of 100 over the course of the last month. And again, it's kind of reflective of obviously the price action there. But that's something that you really need to be paying attention to, and not, let alone the fact that it's going, if you're short it and you didn't cover it, it's going against you, right? So it's going against you, and volatility is increasing, which means that you can see it on the risk ranges. The bands are widening. The top end of the risk range is going higher, and prices moving higher, which is also kind of pulling up the low end of the risk range, which is now at 121. So when you're seeing those things, this is when you got to be conscientious. Okay, like reviewing what your position sizing is, and reviewing like where are you? Am I at my max, my mids, my mins? And if I'm at my whichever level that is, like what decision do I need to make, right? And kind of positioning and adjusting accordingly. So again, just wanted to kind of review that and make sure that everybody's kind of looking at the volatility component inside of their pieces of inventory that they have inside of their portfolio, and noticing the kind of particulars of when volatility is either improving or or getting worse in terms of what's happening. So for instance, like General, can you go back to GDX actually so that was slide 10. We went long in November, and that volatility component was kind of around 65. It kind of hovered around there up until mid to late December on that first little pullback, kind of right where that that D is, which stands for dividend. But that the volatility component started to really move lower after that. So that's a really great sign in terms of, especially when it's something that's in ETF Pro, it's become a core long position for us, and you're seeing the volatility come out of that underlying asset. That means, one, like if at 65, if you made that first entry back when we did back in November, maybe you took it to min or mid and you kept it, I like call it a 2% position or something. But as that volatility comes out of it, and on the pullbacks as we got over the course of that, kind of like going into the late December timeframe, that would start to give you a little bit more confidence in the ability to be more comfortable growing that position closer to your, a little bit closer to your general max of, I'm just going to say 3%, because that's what I said earlier, right? So taking it from 2 to 3, let alone as things kind of really move lower, and we're getting down in that 39 standpoint now on this most recent most recent pullback. But the volatility component and complex is a lot different in the last 3 weeks than it was kind of the last or sort of like the last 3 weeks of the year in December there. So yeah, or sorry, I should say the first 3 weeks of December, after we initially went long the security. So just wanted to, again, like, this is where you can kind of, use that volatility to help adjust your position sizing, review your position sizing, and try to, make a little bit better general decisions in terms of just portfolio construction as a whole.